So permanent funds. Now, once in a while somebody gives a grant or donation, even sometimes tax money gets collected and saved up, and that money has to be used for a certain thing. That is not a fiduciary fund, right? It's be a little confusing because a lot of these things seem pretty similar. So remember, those fiduciary funds are things that belong to other people. We're holding them in trust for somebody else, right? Like a pension. My pension money belongs to me, but the state's holding it in trust for me. That's a fiduciary fund. A permanent fund is something where the money has to stay put and you can only spend the interest in the earnings, right? So somebody might set up a donation for the library, a library fund to buy books, right? So the library is under the governmental funds because it's kind of its own, it's not really its own business like the water department. It's not proprietary. Could be, but probably not. It's probably part of the governmental. Or the police department, somebody sets up a fund to buy police equipment, right? You can imagine a lot of scenarios where people donate money to a city, they want to be helpful. So somebody donates to buy books, and they donate, $100,000. And they say, well, you can't use the $100,000 to buy the books. What you have to do is invest it and leave it in the bank and earn interest, and however much interest you get, you can spend that to buy books. All right, so that $100,000 that they donate is a permanent fund. All right, so it's used for the government's programs. It's not, it belongs to the government, right? So that's how it's different from fiduciary funds. Permanent funds, actually, that money belongs to the government. It was given to the government. And it's going to be used, for some government program. The fiduciary funds, that money doesn't belong to the government. All right, it's being held in trust. All right, so that's a permanent fund. Principal from which is to be invested in perpetuity. That means forever. You just can't use it. You can only use the earnings. All right, so here's kind of a little chart if you ever get confused, right? Because we have a couple of things going on. We also had that special revenue fund. Remember that in Chapter 4, we talked about the general fund and the special revenue fund. Well, special revenue funds, the money comes in and it's for a special purpose, but you can spend it. So a grant that's given for the school lunch program, but you're going to spend it all. That's a special revenue fund. All right? A permanent fund means there's a chunk of money that you have to sit with and not use for another purpose other than this. You can't use the chunk of money, but you can use the interest. And a trust, in other words, it becomes a private purpose trust fund, like my pension, my TRS pension, that's used, that doesn't belong to the government, and it's used for some private purpose. Okay, so that's how you keep it tracked. So what we're talking about are permanent funds right now. And that's how they work. So those are the last of the funds. So we've learned general fund, always one general fund, only one. And there's always one of those, if nothing else. Because maybe not everybody has all this other stuff, but there's the general fund, and the special revenue funds, right? So this is what we're talking about when you prepare the financial statements, right? So when you prepare them by fund, if you'll notice, the balance sheet doesn't have those capital assets on it, like, right? So we use some of our courthouse renovation fund. We must have a courthouse. It's not on here. All we're keeping track of is the funds, so the revenues and the expenditures. The actual courthouse itself is on the government-wide statement. All right, so we're keeping track of the funds. So each of those funds, we talked about general fund and special revenue fund in Chapter 4. We talked about the capital projects fund, the debt service fund, and this example doesn't have a permanent fund, but we discussed what a permanent fund is. So the balance sheet will have separate columns for each major fund, and a column for each non-major fund, if it's not too cumbersome. And the difference between assets and liabilities is termed fund balance. So you may recall assets minus liabilities is fund balance. And we had those categories of fund balance. Non-spendable, which are the things like prepaid rent, stuff that actually cannot be cash. Restricted, committed, assigned, and unassigned. Only the general fund has unassigned balance. So that's kind of a review. Then we have our revenues, expenditures, and changes. So how does it change? So instead of a net income, we're coming up with a change in the fund balance. So you got your revenues minus expenses, plus other finance, plus special items, like we sold a fire truck, that was a special item, equals change in balance. Plus the beginning balance equals the ending fund balance, and that's what goes over to the balance sheet. And remember, all this has been kept track of using modified accrual, so that is an important thing to remember. Statement of revenues, expenditures, and changes in fund balance. Expenditures are displayed by character. So when you're looking at expenditures, you'll see current, debt service, and capital outlay. Alright, so that's it for looking at the funds.